Hi, welcome to this week's video blog at MonsterMortgage.ca. My name is Kristian Harris, and today, as we sit here, we celebrate our one-year anniversary of Mr. Flaherty's fourth set of rule changes. And he started back in July of 2008, and July of 2012 was the fourth change he did. And just to refresh you on what those changes were, I'll quickly go through them. Amortization for underwriting purposes for high ratio mortgages were reduced from 30 years down to 25 years. Now I kind of chuckle because I look back to July 2008 and they were reduced from 40 down to 35. So you can see we've sort of chopped 15 years in the last 4 or 5 years off of amortizations. But that was a big one. So now it's equivalent of a 1% rate increase by dropping an amortization down 5 years. Your payments are higher. Yes, more is going towards principal and you're paying it off sooner. However, it is most Canadians, first-time buyers especially, are going to qualify for less. Second is reduced refinancing from 85% down to 80%. So what does that mean? Well, Canadians used to be able to borrow up to 85% of the value of their home. They can no longer do it. They can only go to 80%. So less Canadians today are taking out less money, equity out of their home than they did a year ago. Elimination of insurance of home prices over $1 million. In the past, you could buy a house for $1.2 million and put down as little as 5%, 10%. Well, now anything over $1 million has to have 20% down. And the insurance company, CMHC, will no longer insure that. So what does that mean? Well, that affects a big part of the Canadian buyer, especially in the Toronto market. When you have people looking at a house north of $1 million, and in many cases, you have a client looking for a $1.2 million home who had $120,000 saved up, 10%. That's a lot of money. To now double that to $240 is a stretch. So that part of the market has slowed down. The spin-off of that is anything listed under $1 million has really been moving, because once you get north of that $1 million, you have to have the 20%. Sounds weird that you'd be buying over $1 million with less than 20% down, but it was quite common, especially in some of the higher end areas in Toronto. And the last one really was credit scores. They introduced minimum credit scores when it came to underwriting, and based on certain credit scores, you could have your borrowing ratios extended a bit. So it's quite complex. But all these changes really mean it's been tougher for Canadians to get equity out of their home, and it's been tougher for Canadians to qualify for mortgages, and that's basically slowed down the market. So people always say, what's going to happen next? What's going to happen next? Well, we have 4 years of changes, and they've come from a 40-year AM down to 25-year AM. It's come from equity borrowing up to 95% on a refinance down to 80 now. And based on Flaherty's comments recently in the paper, I think he sort of accomplished what he wanted to do, which is slow the market down. And you can argue good or bad, and we don't argue good or bad. It is what it is, and he wants to make sure that Canada banks are in good position, and so are the Canadian consumers out there. So I think we've probably seen the last of the changes for a while. But again, recognizing a year later that it has slowed down the market a bit, and it's made it tougher for people to qualify for mortgages. But doesn't mean that people can't. It's just they have to sort of change their mindset to what they could have maybe accomplished a couple years ago, and what was available to them is no longer available in the market. But as we always say, it's very important you speak to a professional mortgage broker who understands what the rule changes are and what they mean to you, and make sure that you're prepared before you go out looking for a house, or if you want to look at refinancing, make sure you come in and speak to someone and understand exactly what's available in the market today. Thank you very much.